Okay, so coming to the strategy is based on the fact that you see this red line, this is the exponential moving average, and this blue line is the simple moving average. This exponential moving average uses a period 5. Okay, so that is it takes into consideration only the average values of the last 5 minutes, and this blue line is the simple moving average. It is taking into consideration the average values of the last 20 minutes. Okay, so as you know that one more example. uh, okay, let's take my personal example. Okay, so okay, person A and person B. Okay, person A is my friend since my childhood. Okay, while person B has been my friend only like from the past 6 months. Okay, so person B will be knowing only those things that has happened to me, like about me, like that has happened during the past 6 months, while person A, he'll be knowing a lot more than person B, right? So the same thing with moving averages. So longer period moving averages will be having the average value of the larger period of time frame, while short period moving average, that is this red moving average of period 5, will be having the values of the only the nearby last 5 periods. Okay, so the shorter period moving average will be close by to the actual price. That is, the moving average price will be closer to the actual price, while the larger period moving average, the price will be a bit away from the current price. Okay, the current price of this candles, how the candle moves, it is according to the current pricing, while the blue line is the larger time frame moving average, and the red line is the exponential smaller time frame moving average. So if you see closely, the red line actually sticks close to the candles, while the blue line, it stays a bit away from the current pricing. Okay, so the strategy is that whenever the red line crosses above the blue line, you go for a buy position. So that is whenever there is a crossover, whenever the red line, that is the closer period moving average, crosses above the longer period moving average, you go for a buy position. Okay, there is one more very, very, very important thing to keep in mind before doing this. That is, you make entries only based on support and resistance levels. Understand? So you are going to trade using this strategy by also having a look at the support and resistance level. So only if a crossover happens above a resistance level, you're going to go for a buy position, or at the time when the resistance breaks. That is, let us suppose that there has been a crossover, and when the crossover happened, a resistance level was also breached. Only in those cases you're going to enter the trade, or else your accuracy will be comparatively lesser. Okay, so if you're using these two strategies combined, it will give you very, very high accuracy. Trust me, guys, like it's going to give you like really good accuracy. Okay, so the strategy is whenever there is a crossover, that is the red line, that is the shorter period moving average moves above the longer period moving average, you go for a buy position. Okay, so today the overall market is down, so it is actually improper to go for a buy position because you're trading against the market. And the next thing is, whenever the red line crosses below the blue line, you go for a short sell position. That is, whenever the red line crosses below the blue line, that is the closer period moving average crosses below the longer period moving average, you go for a sell position. Okay, okay, if you look at this case, this is a wrong trade. The reason is that here this is a region of support, and the level has not been breached, and you are not supposed to trade. Okay, so now if you look over here, the red line moved above the blue line. Okay, we are trading in the direction of market. Okay, it's fine. You could have gone for a buy position somewhere over here. Okay, that is, you could have gone for a buy position somewhere over here. Like once, like there was a cross, the red line crossed above the blue line, that is a buy signal. And after this resistance level got breached, you can go for a buy position. Okay, and coming to this part, it is the red line crossing below the blue line. Okay, you can go for an entry position here, but then once this level gets breached, you can go for a trade, or else you can book quick profits, that is you can short sell. Okay, if you feel the volume is high, that is there is a good downward trend, you can short sell and book profits. Okay, so the strategy is that whenever the red line crosses below the blue line, you go for a sell position, and whenever the red line crosses above the blue line, you go for a buy position. Okay, now we were looking at a time period of 20. Now let's change it to 22. Let's see which is more accurate. Okay, so this varies from stock to stock. Varies from stock to stock in the sense, like different stocks will be having giving better results in different time frames. Okay, but more or less the values will be the same. Okay, so let us take this example. So you short sell over here when the red line crosses below the blue line. Okay, you short sell. Either you book your profits at your target price, or else you wait for a reversal. That is, whenever the red line comes and touches the blue line, crosses above, there is a high tendency of this trend to go up further. That is, like once this red line touches the blue line, there is a high tendency for this to reverse. Okay, so you exit at that position. Okay, so that is the strategy. Yes, I have more example. Okay, this will be applicable in whatever stock you're going to observe. The strategy will be applicable. You can see over here, and the best time to enter these trades. Okay, so according to the strategy, once again I'm explaining, whenever the red line crosses above the blue line, you go for a buy position, and whenever the red line crosses below the blue line, you go for a sell position. Okay, and the best time to enter such trades is when the market is moving, like you see over here. Okay, this is a good region to enter this strategy, to enter trades using this strategy. Okay, you can see the market is moving in a consolidation phase over here. That is, it is actually not moving in any particular direction, it is just moving just a slight movement. And in these instances, the blue line and red line are almost close to each other. See, okay, so you can see the blue line and red line are almost really close to each other and are really nearly sticking to each other. Okay, and as soon as you can see the red line or blue line starts deviating after moving in a straight line together or moving parallelly or sticking to each other for a while, that is, once the red line starts deviating after moving together for a while, that means that is a good entry for trade. Okay, see, you could have seen the values are sticking, the lines are sticking towards each other, but then after some time the line started deviating. So these are like perfect entry points for using this strategy. Yes, you can see. Now if you want, I can show you with any stock you can observe the strategy. It's not just limited to this, you can apply it for anything. Okay, let's, it's uh, applicable for commodities as well. Okay, but make sure that you're always trading on high volume stocks. That is, you're always trading on stocks that are the gainers of the particular day or have really high volumes. You can see from the pre-open market itself, like stocks that are that are having very high volume. So let's see pre-open market. Okay, this pre-open market is not live now. So if you could see seal, the in the pre-open market the change was 1% change. Okay, and the volume was, okay, the quantity was 5565 in the pre-open market. Now if you go to the main home, here as well you can see the volume is 75 lakhs. That is like really good volume. Now we'll see how we could have applied the strategy in seal.